It seems like almost every major stock has been hitting all-time high after all-time high. And if you've been hanging out with us here on the channel, you've probably heard me say before, when it breaks to a new high, it's time to buy. But what happens if we're wrong? There's a fine line, there's a fine difference between a breakout that makes us rich and a fake out that kicks our butts. The last thing we want to see happen is for us to find a strong running candidate and buy as it breaks to an all-time high, meaning we are paying the most for this stock than anybody else in history. And if we are right and that breakout trend persists, we stand to make a lot of money. But if we are wrong, there's the potential for that stock to turn on a dime, run down, take us out behind the proverbial woodshed, and give us a severe beating, hitting our portfolios, not to mention our egos. And we don't want that. In this video, I'm going to show you exactly how we plan and execute those breakout trades. And I'm also going to show you how to properly manage that risk so that you don't get caught in a fake out and that your fragile little ego doesn't have to suffer along with the drawdowns in your portfolio. I'm Noah Davidson. Let's dive in. Now I have a great example for us right now on Palantir. If you've been paying attention to the markets at all, you know that Palantir has been one of the highest flying stocks out there right now. And back in August, Palantir ripped up to a 190 high. And the minute it hit 190, boom, sellers came in. It hit a tipping point and a lot of supply became available and prices dropped. People were not willing to pay more than 190. But the buyers stepped up. They bought the dip down to the 160s and the 155 area, and they soaked up all of the available supply, and demand pushed prices right back up near that 190 high. But because that 190 high was a previous benchmark high, everybody looks at that price point and goes, I don't know, is it worth more than 190? And so they're all hanging out buying right now between 190 and 170-ish. And they're playing a little game called Wait and See, or a game I'm familiar with called You Go First. And what we mean by You Go First is I don't want to buy here until people prove to me that they're willing to pay more than 190. And so we look at that previous benchmark high 190 and we just extend that price out to the right. And that's going to be our entry trigger. If the stock price breaks above 190, that means that at least some traders and investors are willing to pay more, and we can participate in what happens next. Because if they're willing to pay more than 190, well, then maybe they're willing to pay 200, maybe they're willing to pay 210, maybe they're willing to pay 220, so on and so forth. And we could make a profit projection out there, probably near 220 to 230, where we think demand could drive prices up to those levels. And so we would use an order to trigger into the trade called a buy stop. Stop is the word that traders use for trigger. And we wouldn't want to pay too much, so we would use an order type called a buy stop limit. And I'll put LMT for short. So buy stop limit. That will be our trigger to buy. And we'll set that there at 191. Meaning it has to break above 190, 191. Then that will trigger our order to buy and we can get in. Now that creates the problem. What if instead of a breakout, it's a fake out and the stock price turns on a dime and starts to drop? How far could it fall? Well, we know that it established some support at 170. What if it falls down to 150? What if it falls down to 140? What if it falls down to 130? It could get ugly fast because once the sentiment shifts, it's not uncommon for profit taking and traders who got caught in the breakout or the fake out, so to speak, start dumping their shares, and it creates inventory and prices drop rapidly. And so to protect ourselves, we pre-plan our exit. And we use a really simple order technique called a sell stop limit. So it's a sell. Actually, I take that back. Stop, sell stop. And I don't want to limit my exit. So I use a sell stop market, MKT for short. Sell stop market order. And the big question in traders' minds is, well, where should I put that stop loss? Because there's a lot of questions we have to answer in order to place a strategically sound stop loss. I'd be curious to know what stop loss techniques you use before I tell you mine. So put those in the comments below and let's compare notes and see what kind of stop loss techniques you're using, and then again compare that to what I'm using. Now, I look at every stock on an individual level and I try to understand it really from two perspectives. Established price levels or price thresholds that the market has defined, which in this case looks to me to be right at 170-ish, 172. That's a price point where in the past traders have stepped up and bought, meaning they've been willing to buy at 170. So if I was putting a buy order at 191 and a stop loss down there at 170, that means that the risk would be 21 points. And if I bought 100 shares, that means I would have $2,100 of risk if it went down and hit my stop loss. And what I wouldn't want to do is if I didn't like that risk, I wouldn't want to tighten up my stop, because that means it would probably just get hit if I put my stop loss too tight. And so what I would do is make sure I'm using an appropriate position size so that my risk was comfortable. So if I didn't want to have $2,100 of risk, well, maybe I do 50 shares and instead of $2,100, I have $1,050 risk. Or maybe I use 25 shares and I get my risk down to 500. Or maybe I only do 10 shares and I keep the risk down to $210. That's up to me on how I position size. Now, that static stop loss is one technique. A lot of traders like to use what's called a trailing stop loss, or a stop loss that will trail behind it. And there's a lot of different techniques and methods used. One of the simplest techniques is to use a statistic called an ATR, an average true range. And I have an ATR on this chart down here below. It was an indicator developed by a guy named Wells Wilder back in the 70s. And it takes a 14-day sample of the data and just averages out the difference between the high price and the low price. And it keeps a running tally over the last 14 days, which it tells me right here that the statistical average is about 783, meaning between the high price for the candle on the day and the low price for the candle on the day, statistically speaking, it's about 783. And what I would do is I would just round that up to $8, and maybe the tightest I would put a stop loss or a trailing stop loss would be $8. Now, a lot of traders, particularly position traders, don't like using that tight a stop loss. Swing traders, that's fine. Maybe they'll add an extra 10% to that of that ATR. Maybe they'll add an extra 20% to the ATR, or even 50%. If you go 2 times the ATR, 200% of the ATR, that's called a volatility stop. And so you could take the 8, times 2, and a volatility stop technique would be 16 points. And that would give you some cushion or wiggle room so that it didn't just hit your stop loss and then run on to victory without you and then kind of look back and mock you while it was making money and you weren't in the trade anymore. So picking that number, using that statistic, helps us understand what it's likely to move and just put our stop loss outside of that. For newer traders, not confident or competent enough to build and to plan and place breakout trades, what you might want to do instead is look for really fundamentally strong stocks that you like that have gone on sale, that have been beat down in price, already gone through that discounting process, and look for them to find bottoms where they establish some support zones and start to go back up. And if you want to learn how to find those stocks fundamentally sound on sale, you can watch this video here.